The very simple path to wealth is simply investing in index funds and doing this regularly. Now, I'm going to show you a couple of the tweaks that I think make this slightly more attractive. But just as an initial point, let's have a look at the S&P 500 using the very popular SPY. If we'd entered here 20 years ago and we had held to today, we would have had 8.83% total annualized return. Now, this is despite the lows and despite the highs, and this is just a one-time investment. We would have turned the $10,000 into $50,000 almost, and we would have collected quite a few dividends along the way. Now, one of the big questions is, can we do better than that? Let's have a quick look. It's also possible to set up a portfolio such as I have here on the Koifin platform, which I very much love. And what I've done is I've set up a very simple portfolio of the SP 500, Realty Income, and WEC, one of my favourite utility stocks. Now, I set this up to operate in a 50-25-25 split, and we can scroll through here and see a couple of the key points. Now, I set this up as a 25 split for WEC, 25 split for O, and S&P 500 50% split, and this is going to be rebalanced every year. Now, from the style box, we can see that this is tilted towards growth, probably because of the S&P 500 inclusion and weighting here. And we can see that the dividend yield of the S&P 500 is low, but Realty Income and WEC make up for this a little bit. So the big question here is, what is this going to look like in a historical chart? Now, if we look at this just in 5 years, the total returns is very much outpaced, with the S&P powering ahead, particularly since about this time here in mid to late 2022, and powering ahead driven by the AI stocks. But it's more interesting when we go back, say, for example, 10 years, where we see that there's been periods of outperformance with my very simple model portfolio, as well as going out 20 years, where in fact, coming out of the global financial crisis, we can see some sustained performance. And while the gap's been closing in recent years, we can see that the simple path to wealth portfolio here of 3 holdings would have powered ahead with a 750% return, reinvesting all dividends. Now, if we go all the way back, so this is data here from 1994 through to 2024, and the simple portfolio would have returned 2,700% compared to the S&P 500's 2,000%. We would have seen less of the exuberance in the dot-com bubble, but we also would have missed the big decrease in prices there, with some steady gains into the global financial crisis, pretty much the same type of drop there, and then stronger gains coming out of that and onwards. Now, if we look at the historical returns for this very simple portfolio, then we can see that there's been a couple of years with decreases, the biggest decrease here coming from the global financial crisis, and then again in 2022. But most years it's been a positive portfolio gain, or a couple of very minor dips down, and powered by the S&P 500, we've also had several years here with 20, 30, 25% gains, and I like that very much. When we begin to look at the drawdown chart here, for example, in blue is my portfolio, and we can see that in the dot-com bubble, we missed that largely. However, in the global financial crisis, the drawdowns are comparable to the S&P 500 in grey, and we've been seeing comparable drawdowns since. Now you can say, Lincoln, well, what does all that mean? Well, number one, that's a very, very simple portfolio. And as a very simple portfolio, we could also ask, well, what does it look like then in terms of the income? Because the income, my friends, is of vital importance. Now, I've turned here to Portfolio Visualizer. Now, with a free account, I've only got 10 years of historical data, but I've set up 3 portfolios, as well as comparing this to a simple Vanguard 500 investor. Now, if we look at these portfolios, I've done a couple of simple things. Number one, we have this portfolio here, which is a sort of a balanced portfolio. Number 2, I have that very simple portfolio of 50%, 25%, 25% that we just looked at. And then number 3, I have thrown Aries Capital, a strong BDC that pays a roughly 10% dividend yield in good times and usually even in pretty rough times. Now, Aries Capital has only been around since about 2006, I think, and they paid dividends fairly consistently, with one small decrease going into the global financial crisis. And so the big question is, what do these look like? And if we look at the S&P 500, 12.72% return, my 2 simple portfolios returned less than that. But if we look at the maximum drawdown, my simple portfolio with 3 holdings was comparable to the S&P 500 maximum drawdown. Portfolio 3 was higher. The Sortino ratio, which is one of my favorite metrics for whether or not this is a good portfolio, is pressing close to 1. So again, it's not a perfect portfolio, and I know we can do better. But that's not the point right here. I just want to illustrate how some very simple portfolios can be powerful. Now, it's also important to note that when I set this up as well with a simple assumption that we were going to contribute $1,000, and then after that we would contribute $100 on a monthly basis, and we would inflation adjust that and would rebalance those proportions on an annual basis. So there's a small amount of money at the start and there's a small amount of money going into it at the end or during every month. Now, given the fact that this is only 10 years of data, we started with $1,000, we added $100 a month. This is something that I think most people could probably achieve and manage, and yet with these very simple portfolios, we would have ended up with $22,000. And in fact, the actual end balance for my 2 portfolios here is very, very comparable. Now, I think it's important that we look at the portfolio income as well, because this gives us a good sense of the dividend snowball and the benefit of long-term dividend investing with good dividend cash flow. Now, in 2015, so in the first full year, we have Portfolio 3 returning $82 of income, a balanced portfolio returning $39, and my 3 model portfolio returning $49. And by and large, it doesn't look too different. And it's really not, I think, until we get to about 2019 that we see Portfolio 3 pulling ahead with more than double the income from the balanced portfolio. And again, in the coming years, it pulls away further and further with much more than double the income from that portfolio. Now, in 2023 then, so this is over a 10-year period, or even less than 10 years, really. Remember, we contributed $1,000 at the start, $100 a month, and now we have income from portfolio number 3, which includes Aries Capital, a nice BDC. We have income that's almost $1,000 per year for doing very, very little. What happens if you hold this for longer? What happens if you were to hold this portfolio for another 10 years? Again, not adding very much, but adding it on a regular basis. What would this grow to? How would that income change your life? And $1,000 is not very much. But remember, that's how much we added in the first year. And that's very similar to what we would have been adding every year after that. So after 10 years, we actually have a reasonable return on that income. We would have seen good years. We would have seen a bad year, but that's not as bad as the bad year from the S&P 500. We would have seen a maximum drawdown worse than the S&P 500, but not overall for a long time, because the worst year was only minus 7%. So we would have seen it bounce back reasonably quickly. Now this, my friends, is essentially that dividend snowball action. Add time, add patience, add income, and keep on investing, and this is where the magic happens. And this is a situation where even in the COVID crash, we were adding. Rather than selling our investments in this decline, we were adding. We were reinvesting our dividends. We continued to add every month. We were buying more units at the lower prices because of the decline, and that actually begins to then power our returns as we exit that period. If we look at this then, from 2020 to 2021 and 2022, we might expect the income to really sort of accelerate. And indeed, 2019, $427, $515, and then a reasonable acceleration to $645, and then in 2022 bumping up to $815 for Portfolio 3. Now just a reminder, Portfolio 3 is a very simple portfolio of some good long-term picks with S&P 500 there just as a sort of a core and satellite. The market here with the S&P 500 is going to give me market returns. I've got some utilities, I've got some real estate, and I have some lending with Ares Capital, almost private equity. Power this together and you have powerful returns, regular income, and income being added to your portfolio even during these down periods in a way that's going to supercharge your income with time. And here, my friends, you can see the dividend snowball effect really beginning to kick in after 10 years. So what do you think? Is this a very simple approach? Is this an approach that you can follow? Now, if you're interested in learning more about BDCs and having a look at some of the BDCs that I've been buying recently, I think you will find this next video helpful and enlightening. So my friends, let's get into it.